Hello friends, welcome to Stock Market Education YouTube channel. Let's start the video. I think you may be aware that as per top-down approach of analysis, stock market analysis, many macro events affect the direction of our Indian market, right? One major event among them is RBI Monetary Policy decision, which is the interest rate decision and other policies which they take at the MPC meet every 2 months or so. Now, you might have observed that this event has the potential to affect the market not just for one day, but for several days. So, don't you think that as an investor, we must understand this RBI event completely? Most people think that an RBI meeting is only about whether interest rates will be increased or decreased. But that is not all. Let's talk about what else is involved and how they affect the market trends. Ready? First, to understand this topic, let's set up a base, like an initial understanding. See, who runs or controls a country's economy? There are two people roles here. One is the government and the other is our central bank, which in our case is RBI, Reserve Bank of India. Both of them want the economy to grow. They regularly track whether the country's GDP is increasing or not. And so our incomes, people's income and spending power are growing or not. Okay, now at the same time, they must ensure that inflation is under control too. Don't you think so? See, even if we have more money to spend, if the prices of the goods kept rising, there's no benefit, right? So inflation should be under control. Now, to maintain growth and inflation properly, when government takes certain policies, that is called fiscal policy. This includes the things like giving money to people, subsidiaries, spending on projects, or increasing or decreasing the income tax, etc. etc. We will talk about these fiscal policies in some other video. In this video, we are focusing on the RBI policy, which is also called as monetary policy. See, if government does it, it is a fiscal policy. If a central bank does it, it is a monetary policy. So now you understand why this meeting is called RBI Monetary Policy Committee meeting, right? Okay, the base is set now. If you found this useful, please like, share, subscribe. Now, we have some more technical terms to know. See, through monetary policy, the RBI can do two things. One, it can make more money rotate in the economy. Technically, this is called injecting liquidity. When they want economy or else the GDP to grow fast, they inject liquidity into system. So, since RBI is being soft on the economy, that is, it is for the economy, and soft on the economy, it is called dovish. On the other hand, if RBI wants to control the inflation, forget about the growth, it wants to control the inflation, what might it do? See, why does inflation rise? There is something called as demand side inflation. When people have too much money, they spend excessively. So suppliers increase the prices, which is nothing but inflation, right? So to reduce this inflation, what should be done? People must spend less, right? So what RBI does is they must somehow reduce the cash rotation in the economy. This is called as sucking the liquidity. Since this decision is harsh or strict for the economy, it is called hawkish. So I think from now you can understand the statements in the news channels when they say RBI is dovish, RBI is hawkish, etc. Right? Now, the next step. What we should learn now? We should know how this RBI injects or sucks the liquidity out of or in the system, right? There are mainly three ways, three weapons of the RBI. One, CRR, cash reserve ratio. Two, OMO, open market operations. And three, repo rate. First, let us check about CRR, cash reserve ratio. See, when we say cash is rotating in the economy, what does it mean? That people are spending more. To spend more, they used to take the loans more, right? So the liquidity is rising in the system. Now, who lends to the people? Normally, it's banks, right? To give loans, bank mostly use the money we put in savings bank account or the fixed deposits. So, for example, if you deposit 100 rupees in a bank, the bank cannot give full 100 rupees as a loan to someone else. Some percentage of that 100 rupees must be kept with RBI for safety. Then, the remaining money can be given as the loan. Currently, the CRR is around 4.5% or something like that. This means for every 100 rupees deposit, 4.5 rupees must be kept as cash reserve with the RBI and remaining 95.5 rupees can only be loaned out. So, what if this CRR has been increased by RBI? Banks will have less money with them to give the loans, right? Because more money should be kept with the RBI. So, the money supply in the economy decreases. Did you get or not? Now, if RBI decreases this CRR, then banks will have more cash with them to lend loans, and then so they lend more and the economy like booms, etc. Now, you may think that the 1% difference is not so much effective, right? See, the total deposits in Indian banks are around 250 lakh crores. So 1% of that means 2.5 lakh crores. 2.5 lakh crores, is it small or large amount? So by changing CRR, RBI controls the money available with the banks for loans. Right. Now, second thing, OMO, open market operations. See, every government needs money for its expenses, right? Some of it will be arranged from borrowing. Government borrows money from its own citizens through issuance of bonds. See, RBI or banks can also buy these bonds. Now, there is also some rule from RBI which states that some portion of the bank's deposit should go in the form of liquid funds, that is, these government bonds, etc. Now, what does RBI does from OMO, open market operations? See, for example, if money supply is decreased in the banks, so banks don't have any money to give away the loans, right? So what RBI does is it buys bonds from the banks. So bonds are transferred from banks to the RBI, and the money is transferred from RBI to the banks. So what happens? Now banks will have more money to give the loans, and again rotation starts and all. The opposite also happens. When there is too much liquidity and high inflation, what RBI does is it instructs banks to buy the bonds from RBI. So whichever money is excess left with the banks will be transferred to the RBI, and RBI transfers the bonds to the banks. So by this way, what RBI can do is through OMO, open market operations, it can inject money into bank, or it can take away money from the banks too. Right. This is the second weapon. Now, the third, the one word which shakes the market, repo rate. We said banks give away loans from deposits, right? Which is true, but they also get money from the RBI. When a bank needs money, the RBI gives a loan to the bank. The interest rate on this loan is called repo rate. If repo rate increases, banks get money at a higher interest cost. And so banks also increase the interest rates on the loans which they give to us. So what does this mean? EMIs will increase. So the demand for the loans may decrease due to the sentiments and all. And so what happens? The liquidity in the economy falls and so on. And also vice versa can also happen. If repo rate decreases, the banks can also decrease the interest rate which they lend to the customers. And so the demand for the loans may increase, which injects liquidity in the system. Now, let me tell you a very important point. See, almost 90% of the money which they lend to the customers comes from the depositors like us. And the remaining thing, or very little amount, they take from the RBI, and that too for the short term. So here you should get a big doubt. Like if 90% of the money is public money and only 1% or 2% is from RBI, why do our EMIs increase when RBI increases the repo rate? It's just small portion, right? There are two mind-blowing reasons for it. One, the gravity effect. See, repo rate is like a gravity for the market. If RBI increases the repo rate, returns on safe government bonds also increase. That is, the expectations from the government bonds also increase, right? So to compete with that and attract public deposits, bank must also increase the FD rates, right? So when the cost of the raw material, that is FDs, increases, they must increase the loan rates too. Is it or not? Second thing, the RBI master stroke, EBLR. In 2019, RBI made a strict rule. Like whether a bank borrows from the RBI or not, every home loan or a car loan must be linked on the external benchmark. And guess what? The external benchmark is nothing but repo rate. So if repo rate increases, loans should increase. If repo rate decreases, they should decrease the loan rates. So even if your bank doesn't take a single rupee from the RBI, if RBI increases the interest rate by 0.25%, your EMI should automatically increase too, but on some time delay. Okay, now before moving to the next topic, there is something called as status quo or pause. If inflation and growth are balanced, then RBI doesn't change the rates. It doesn't increase, and at the same time, it doesn't decrease too. It just holds the rates. This happened many times, and it is called as status quo or pause. Now, apart from this decision, in the stock market point of view, what stock market mainly focuses is the statements of the RBI governor after this decision too. Like the GDP expectations, the inflation targets, what he expects on the economy. These are all forward-looking statements. So the market gets an idea on how the economy will be in the coming quarters. And based on this data, the fair value or the intrinsic value of the stocks in the valuation formulas changes and all. So that is why market reacts more to the commentary rather than the actual decision too. Get it? Now, the last topic. Why increasing rates is negative and decreasing the interest rates is positive for equities or stocks. See, when the repo rate increases, bank increases the interest rates too, which we have learned. Now, this applies to the new loans and the old floating rate loans too. Now, if the interest rate is increased, people with existing loans have to pay higher EMIs, right? So the spending power decreases. Even if the EMI doesn't increase and just a tenure increases too, maybe because of the sentiment, they spend less. So the spending power somehow decreases. So when people spend less, company sales may decrease and earnings might fall. Also, for the new spending also, like home loan and car loan, EMIs will be increased, right? So because of this, loans become more expensive, companies stop new projects and expansions, and also people may buy less of homes or cars, etc. So somehow the liquidity in the economy decreases, and thus the corporate earnings may fall too. See, whenever you see, the market always focuses on the future, not present, right? Now, if there is a rate cut, exact opposite will be done. Loans become cheap, companies borrow and expand, and public spends more, corporate earnings rise. So it is generally positive for the stock market, right? And finally, there is some other term called risk-free interest rate. See, while calculating the intrinsic value of an equity, that is the stock, the risk-free interest rate is used as a reference. For example, if bank gives 8% interest on your FD, and if someone comes and asks you some loan as an amount, what might you do? You might ask for 12% interest rate, right? Now, if the same banks offer 12% interest on the FD, what will you do? You ask for 15% or 16% interest rate to whoever you are giving the loan, right? Why this happened? Because the expectations increased due to the risk-free interest rate increase too. Similarly, in equity valuation, there is an effect of this risk-free interest rate. The risk-free interest rate is nothing but maybe the FD rate of SBI. Got it? Now, this rate depends on the repo rate, right? So if repo rate increases, this risk-free interest rate also increases, and so investors expect higher returns from the equity. Therefore, the current intrinsic value should be lower than what it is now, leading to the selling pressure. Got it? This particular point, I think you may be confused somehow. So we will talk about this in some other video. So I hope you understood the main topic, RBI monetary policy decisions and its effect on the market. I tried to explain you in a simple way to increase your knowledge. So to watch more of these videos type, please like, share and subscribe. Jai Hind.